Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gives you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts on the show. Joining us today are Vivek, Mavani and Sharmila Joshi, who are independent investment advisor. On the show today, we talk about the infrastructure space and whether is there any company that can be accumulated. IndusInd Bank has seen a sharp dive in sentiment post the IL&FS exposure and multiple downgrades. We ask our analyst whether they are concerned about the same on the counter. The other one is RITES. RITES is going to consider a bonus issue next week. We ask our analyst what the view on the stock is, given the fact that the stock has done rather well for itself. And we ask our analyst about one mid-cap stock they believe is worth buying for 1 year. Given the fact that the market is becoming extremely dull and boring, one stock that should be accumulated on every dip and decline. But we'll start with the first one, and that is the infrastructure space. Now, what we did was we actually tried and analyzed what a lot of these infrastructure companies have done. But what we saw was that at least in compared to UPA 2, NDA 1, a lot of infrastructure companies did extremely well as far as their revenues were concerned, as far as their execution was concerned, as far as their profitability was concerned. Whether the trend is there, whether this is the sector you should be in, or whether it's the sector that probably will take much more time to recover, that's something that we want to talk about. So Vivek, I'll start with you. Your sense on the infrastructure space, anything that you like in this space, or like many, are you averse to investing in infrastructure?
Well, I'm slightly averse to investing in infrastructure for a couple of reasons. I mean, you and the viewers over a period of time would have noticed that I prefer companies which generate return on capital, return on equity upwards of 15-18%, preferably should not have much debt and generate free cash flows, I mean with strong balance sheets. Now, yeah, as far as infrastructure as a sector is concerned, what we have is that the business models prevalent in the last 15 years or so does not permit the infrastructure construction companies, or even an extension of that, people who take the HAM projects or BOT projects, I mean infrastructure companies who also do that, take the longer term risk of revenues from the project that they are executing, does not permit them very high EBITDA margins. As a result, what you have is not very high return on capital, return on equity on a cycle basis. 1 or 2 years they may earn 15-18%, but over a 5-7 year period, can they sustain that 15-18% return on capital? That's been a question mark. And one of the reasons is the high receivables which they need to receive from the government agencies, whether it is NHAI or the state government. A lot of the projects now are undertaken by the state governments and independent agencies, like most metro projects. I mean, it's an independent agency, which is a corporation in most cases. Now, those dynamics aren't changing. So yes, in the last 5 years, we saw several of the infrastructure companies do very well on the execution side. But this part of the business model of receivables being like 4 to 6 months, hurting their cash flows, hurting their return on capital, return on equity, I would wish that to change. Not that their valuations also are so compelling that I would be inclined to dilute the parameter of return on capital and cash flows. So there is I have a suggestion to play the infrastructure theme in a different way, and we'll be discussing RITES a little later. I mean, it's coincidental that we are discussing the infrastructure and RITES as a stock on the same program. But I would prefer to play it by the engineering consulting companies rather than the infrastructure executors, not the construction companies.
Okay, that's the view that's coming in on from Vivek. What's your sense, Sharmila, on the infrastructure space? Anything that you own or you've told your clients to accumulate?
Well, not really asked anyone to accumulate, but I think yes, increasingly going forward, maybe the space could get interesting. And yes, I think the problems that infra as a sector have faced are pretty well known, given the fact that we've seen the pressure on margins. Also, we've seen that some of the big names that have gone, like for instance, IL&FS, etc., they did have infrastructure projects. Also, we've seen a whole host of auditor concerns hit some of these stocks. So they've been hit by multiple issues, So it's while you can argue that execution has been good, I think the margins have not been there, and the headwinds have been multiple. Within that space, I think NCC is a stock. I'm sticking my neck out here and saying this, but I think NCC is a stock that you can look at. And there are a couple of reasons for this. I think, one is that really the sort of the concerns on NCC started ever since, we saw the separation of the two states, because they are concentrated in that space, and, there was a little bit of a worry at that time, how things are going to fall in place for them. But I think now they're over that, and I think they have exhibited that in their numbers over these last couple of quarters, where numbers are beginning to look good, order inflow is good. The management has sort of sounded out one concern, saying that, they've heard that the new government may cancel some orders which are yet to start, and their order book could get impacted to the tune of 6,100 crores. But of course, over the past 1.5 months, we really haven't seen any or heard anything further on that. But I think given the fact that their earnings are looking good, their order flow is good and likely to improve from here, I think this is a stock that one can look to buy, especially as you said, if you see those dips, then this could be a stock that you could acquire.
Okay, that's the view that's coming in. Vivek, just one quick question. Obviously, you'll speak on RITES, but you think that the argument on infrastructure compared to L&T, that there's no other alternative that holds, is L&T something that you would look at in this space?
I may consider L&T simply because it's part of the Nifty, and if I need to have a fair representation of the index in my portfolio, then I really don't have, or not me, but most people don't really have a choice but to have L&T also in their portfolio. But besides L&T, I mean, I'm not saying there aren't good enough companies. I mean, like she mentioned of NCC, I mean, even say a Gayatri Projects is a respectable company. Dilip Buildcon has done very well over the last 5 years in terms of scaling up. I mean, there have been clouds about the political affiliations of some of these companies. I'm not commenting on any of those, but purely from a business point of view, they have done well. I'm not comfortable, firstly, on the business models and the valuations, which is why I stay away.
Okay.
So I've got alternatives to play.
Just add there, I don't know whether it's fair to call Larsen an infra company.
Okay.
I mean, when you talk of infra, I would assume we are talking of companies which are, into building roads.
But it does that. Majority of its business comes in from the construction business.
I think it's more a capital goods play to my mind than really larger projects and more sort of, turnkey projects than some of these companies.
But the turnkey projects are because of the EPC projects that they do.
Absolutely.
Infrastructure in capital goods is a small part. They do a lot via hydrocarbons. They got a lot of defense. But obviously, you have a view on L&T as such?
No, obviously, I think as Vivek said, I am positive on L&T, but it's had a run up, and yes, numbers were good. And also, I think for me, the heartening thing was that you're beginning to see some of the pressure on margins lessen over there, which is always a good thing, because there was a time when you were seeing pressure on margins even in L&T. So you thought that, oh my gosh, like even if the leader in the pack is seeing the pressure, imagine what happens, sort of down the line. But now that picture is changing and improving.
So my thing is that with over the past few years, we've seen pressure on the infrastructure stocks. They haven't performed. Their financials they've done well compared to UPA 2, but they still haven't done exceptionally well. With issues in the housing space, with issues in NBFCs, will probably this get worse for the infrastructure space in the next few years?
Well, I think since it's a sort of going to be dependent also on the kind of spend that they see from the government, hopefully things will get better. And the housing problem is completely, it is more builder driven and more developer driven. So that is going to take time, and also, one hears all the while about the kind of inventory build-up that there is in housing.
But it affects them because these are the guys that build the building.
Yes, but as I'm saying, they're like for instance, for NCC, a lot of their order wins are from their core sector, where they're talking of anything, meaning anything sort of government spending related. So that is for me the good thing about the order flow.
Okay, is that something that you tend to agree that probably with the crisis in the NBFC in the financial space, things probably over the next at least 2-3 years will get worse before they start getting better?
Well, I don't know if they'll get worse. I doubt it. Quite honestly, I doubt if it'll get worse. Yeah, you compared it to UPA 2. Well, I compared to UPA 1. I mean, the period between, say, 2004 to 2008 was probably the golden period for infrastructure companies, and that was also probably the best period in terms of the rollout of infrastructure. I mean, a lot of the large projects that we are seeing today were conceptualized, and the execution had started that time. In between, the execution slowed down, but now a lot of the execution is picking up with. Now, what we also have is even state governments being much more ambitious in terms of the size of the project, scale of the projects, the scale of funding, and the options of funding in terms of state governments directly going overseas and raising money directly for the projects via SPVs and so on and so forth. But the crucial issue to address, which is inadequate margins that compensates for the return on capital, return on equity, still doesn't get addressed. That's number one. But I don't think it will get worse for the simple reason that what we have is a very pragmatic minister, Nitin Gadkari, who's at the helm of the infrastructure space. And he's realized that in UPA 2, all infrastructure companies got into trouble, which affected the execution itself. I mean, the companies just stopped doing the work because they didn't have the money. Now, I'm sure he's pragmatic enough, the current government is pragmatic enough not to have such a scenario repeat. So I don't think it can get better. I think it can. I don't think it can get worse. I think it'll get better actually.
Okay, let's move on to the next stock, and that is IndusInd Bank. Now, 3 or 4 months ago, or probably 3 or 4 quarters ago, this probably was the stock to be in. Everybody, it was hitting new highs, but sentiment seems to have turned sour, and it started with the entire issue of IL&FS. And now it's down 28% in the last 12 months. There is enough selling, and the investor community is obviously concerned with what's going on again, because day in day out the counter just seems to be heading on the southern side. So are these concerns serious? Are you sensing any bit of problem that is there with IndusInd Bank?
No, I think it's a sentiment hit. As your headline said, I think the sentiment has completely turned sour, not just for IndusInd Bank, but I think any bank out there which has not delivered, or where more concerns have sort of emerged. And when they delayed their result, and when they came out, when they spoke of IL&FS, market is reading a lot more into it than they would have earlier. Nobody is willing to take things at face value anymore and say, okay, this is the picture that is shown to us, and this is probably where it's going to end. But market is now extrapolating and thinking that this could get worse, this could also be a problem, something else could emerge. So very simply put, I think even at this price, valuations to me still look expensive. So yes, I'm concerned, and I really wouldn't recommend a buy even as of now.
Okay, what's your sense on IndusInd Bank, Vivek?
Well, I think the stock has a lot more downside. You could highlight a lot more before I give any target prices. But one is, yes, the company has gone through a serious sentiment hit in the last 6 months, which has led to a derating. Let's recollect when it was at about 2000 odd levels about 3 quarters ago. It was trading at almost 5 times price to book based on FY19. So last year was 1 year forward, which was March 19 book value of about 440. So it was close to 5 times, which was at a premium to HDFC Bank or even a Kotak Bank. But by quality, what we now see after the 4th quarter numbers is by no means they deserved, even at that point of time, deserved the valuation multiples comparable to HDFC or Kotak Bank for the simple reason the quality of the book left a lot to be desired, number one. Number two, from an accounting standpoint, even after recognizing 3,000 crores IL&FS exposure as an NPA, so their NPAs jumped from 1% to 2% as of March, but their provision coverage is still only 54%. So it is not just enough to recognize something as NPA, it's also important to provide for it in your P&L account, which they have still not fully done, number one. Number two. Number three, exposure to 4 large doubtful names, all of which have come up only post March, which is the ZSL Group, Diwan Housing, ADAG, and India Bulls Group, which is a question mark. We still don't know what's happening there. And latest, we now have even Syntex, almost close to 7,000-8,000 crores of aggregate default, likely NPA. We don't have clarity as to what exposure IndusInd has to those groups and how much has been provided. I doubt if it has been provided at all as yet, because the default and the downgrades happened only in the April onwards. Fourth thing, in terms of their sectoral exposure, about 16% is to the 4 sectors where there are serious problems, which is the NBFC space, real estate, infrastructure and construction. That it's these 4 constitute about 16%. We are not even including the traditional NPA contributors, which is steel, power and textiles, which have last 20 years repeatedly given the banking sector a lot of headache in terms of bulky NPAs. If you include those other 3 sectors also, IndusInd has almost 25% exposure to these sectors. Now, I'm not saying all of it is bad, but even if a 10% goes bad, your 2% NPA jumps to more than 4%. And assume a 70-80% coverage ratio, what you have is like almost 10 to 12,000 crores being additionally provided or requirement for provision over the next 4 quarters. I'm sure they'll spread it over the next 4 quarters. Now, if I were to say 10,000 crores or 12,000 crores of additional provisioning required. Well, the book value or the net worth as of March 19, IndusInd was about 26,000 odd crores. So, you know, the magnitude of write-offs which potentially can come. I'm using the word potentially. I don't think, I seriously hope that all of it doesn't happen. But the market seems to be extrapolating and market seems to be taking that worst case scenario. Yes, this is going to happen. That it is going to be probably hitting some sort of a trouble very soon. Any amount of comforting words from the management is not being able to convince the market because post the fourth quarter results, management came out pretty strongly and very confidently that things aren't so bad. But market doesn't seem to believe that, which is why the stock is going down. And so what we have is a derating of the price to book multiples. My sense it will probably go down to 2 to 2.5 price to book multiple, similar to what Axis Bank Axis Bank had a couple of years ago. That the worst of it, Axis Bank was less than 2 times price to book. So through the whole cleanup process, probably IndusInd could also go through that. So what we are talking of is a price of maybe 1,000 or even less over the next couple of quarters. That's possible. I hope not, but it's quite possible.
Okay, that's the view that's coming in on IndusInd Bank at this point of time. The next stock is RITES, a counter which has managed to do well after listing. What's the view? We'll ask them. It's down almost 1.5%, but a bonus issue is something that probably kept the stock excited over the past few days. I believe you had some view on RITES also.
Well, I like the stock. I mean, I've liked it since the time of IPO and I had personally invested in the IPO, which was at about 180 rupees last year. It has done, quite well, more than 40% returns, while most mid-cap stocks have struggled to even deliver positive returns. What I like in RITES is an asset-light business model, number one. It's into engineering and consultancy, primarily in the railways, but they've extended themselves to from the railways to metro rail projects, high-speed rail, urban infrastructure. Now they're also getting into airports and so on and so forth, and into turnkey projects also. So from pure engineering and consultancy, which is the intellectual part of the business, which is very high margin, free cash flow business, they're also getting into turnkey projects, which is the execution side of it. As the execution grows, maybe their margins will slightly come off because the margins on turnkey projects are lower than the engineering and consulting, but this company can very well afford to do that for a higher growth, number one. Number two, a very strong balance sheet, debt-free balance sheet, more than 1,200 crores of surplus cash on the balance sheet as of March 19. This is net of the advances from customers, because they also take advances from customers, which sits as cash and cash equivalents on the balance sheet of RITES, and whatever treasury income they earn is passed on to the project. So they don't earn that. It's a pass-through. So I'm excluding that part of the cash and cash equivalents, which is on the balance sheet. It actually doesn't belong to RITES, but it's sitting there because the projects are under execution. From a valuation point of view, from a return on equity point of view, in spite of the cash pulling down the return on equity, it still has delivered 18% consistently over the last few years. From a valuation point of view, it's about 8 times EV by EBITDA and just about 12 times earnings, which to my sense is quite cheap when one looks at a 6,000 crore order book that they're sitting on now. 6,000 crores order book is about 3 times their annual revenues that they did last year. In the sense March 19, they closed the year with about 22,200 crores of top line. So next 3-4 years, they're pretty much assured on the growth. They've guided on the margins to be stable, and the strong balance sheet only gets stronger.
What's your sense, Sharmila, RITES?
Very honestly, I have no recommendations, and I think it's interesting as a concept, but I haven't really gotten my mind around to all the moving bits and how they're going to really deliver over a period of time. Though this is an IPO, obviously, that has fared much better than a whole host of IPOs we've had in recent times. So I'm just watching it for the moment. I don't really have any recommendations.
Okay, and what about a mid-cap? That's the last stock that we want to discuss. Any mid-cap stock that you've told your clients recently, or you personally have accumulated, you believe that should be held as an investment-grade company?
So I'm looking at Marico.
Okay.
I think the whole FMCG space has taken a big knock, post last numbers, and we've seen the hit has really come on the kind of volume growth that you've seen. Marico, I think, reported a fairly decent quarter. And also in terms of the kind of product that they have and their that part of the business, I think this is going to sort of weather the macro slowdown better as compared to some of the other stocks within the space, given the basket of products that they have. And I think that going forward, there could be 2 or 3 ideas that you need to work with. One would obviously be the safe bets, which is IT, which we have spoken of, in your previous shows at great length. And then I think you need to look at things that could do well because of the budget or some changes in GST. And I think the third play will obviously be consumption. And I think within the FMCG names, this could be a stock that would sort of move ahead of the other FMCG play. So
valuation-wise, how does it compare?
It stacks okay. I think it's not as expensive as some of the leaders, but it's not as cheap as you would like it to be. So if you get those drawdowns, if monsoons don't pan out the way your monsoons are also seeing a slow start. So you could see some correction. Market is also correcting. If you get the opportunities, try and buy it lower.
Okay. What's your sense? Which is the stocks that you personally have bought or told your clients to recently accumulate?
So Bharat Electronics bought on behalf of clients, have an interest in Bharat Electronics even at in my personal capacity. So although the stock has rallied 30% from the bottom, at the worst it had corrected 60% from the top last year. Even now it's at least 40% lower from the top, but it's an attractive bet from a long-term point of view. One is the monopoly situation, monopoly status that it has in supply of defense-related equipment and systems, software included, gives it a strong, I would say, position. So they have a order book as of March 19 of almost 52,000 crores, 51,000 plus something crores, which is on a revenue base of March 19 of roughly about 12,000 crores. So more than 4 years of book to bill ratio but it assures them 20+% revenue growth at least for the next 3.5 years, only on the current order book with stable margins that have been roughly about 20%. Q4 was exceptional with 23%, but the normalized margins are roughly about 20% EBITDA margins. That's number one. Number two, again, a very strong balance sheet, surplus cash on the balance sheet, upwards of 1,000 crores as of March. Last year, they did a buyback at 181 rupees. And it's a dividend, a reasonably high dividend company relative to a lot of PSUs. And dividends also rising in line with earnings growth. Consistent return on capital, return on equity of 18-20% range over, like, I mean, if I may to look at history, maybe 20 years of 20% return on capital, return on equity, more normalized would still be about 18% as the company grows. And from a valuation point of view, again, it's about 8 times EV by EBITDA. It's about 12-13 times earnings, again on historic basis, so it'll be probably 10 times on a 1-year forward basis. Only one issue with this company is little lack of predictability in terms of lumpiness of the revenue. So quarter by quarter, there could be surprises that from the point of view that the growth may lag, or maybe the growth may be higher or lower quarter by quarter, sometimes even year by year. So there have been periods when it has grown in single digits, there have been periods when it has grown like more than 20%. So that's the only thing in Bharat Electronics, but I think the valuation makes up for those concerns. So from a long-term point of view, I would be a buyer on every decline, and even at the current price of 109, 110, I would be a buyer.
Okay, that's the view that's coming in. Marico as well as Bharat Electronics are the stocks that have been spoken about as long-term investment bets. But with that, it's a wrap on today's edition of Hot Money. Let me thank my guests for coming in. Sharmila, thank you so much. Vivek, thank you so much for coming in today. Ask BQ comes up next. Stay tuned to Bloomberg Quint.